Hey folks, Dr. Jeff Camarda reporting Monday, April 27th. Another fairly calm day in the markets, modestly up a little bit, some chop, nothing really to talk about. We have a number of important companies, including major tech firms, reporting their financial results for Q1 this week, and I'm acutely attuned to the market's reaction to these numbers to guide our strategic deployments going forward. Again, this is in the backdrop of, the market continues to be fairly buoyant and I think over optimistic. Maybe it's accurately priced in what's going to unfold for the economy. I doubt it. I've got some notes over here, so forgive me from looking away. But the first thing is that the U.S. deficit is now projected by the federal government, not from an outside analyst, to exceed gross domestic product, which is a huge number. It hasn't been this high as a percentage of GDP since the 1940s when we were financing World War II. So that's a pretty ominous sign, and I think probably they're underestimating the amount of money they're going to have to borrow or create or whatever, how much bigger the deficit is going to go. And that certainly is not a promising economic harbinger. So I think this is probably going to get worse as more money is required to float small businesses and to buy assets, which is what the Fed's doing, which is a major reason, by the way, that explaining, or the pundits use to explain the stock market's buoyancy, is you can't fight the Fed, and that's true, but they're buying everything in sight, so that's relieving offsetting a lot of selling pressure. But also we have to look at the fact that gross domestic product probably is going to go down significantly, as this cancer chews through the economy. Before things get back to normal. So I think that ratio, debt compared to gross domestic product, is probably going to get worse than a little bit more than 100% of GDP, which is where it's currently forecast by the Fed, or the federal government, I should say. The next thing is, some other ominous news over the weekend. Consumers in droves are just not paying their credit card bills because they don't have the money to do it. Municipal bonds are increasingly at risk, and we don't have any municipal bonds in the Camarda portfolio. So those of you that are not Camarda clients that may be listening to this may want to take note that there's a lot of instability there. And with the Republican leader of the Senate, his public position being that states and local governments should just declare bankruptcy. I'm not sure they can, but in absent a federal bailout, they're just not going to have the revenues to pay the interest and pay off the bonds as they come due. So that's not a very good sign for the municipal bond market. And the last thing I'll comment on is that there are some significant tax breaks associated with the COVID sheaf of legislation. One of which allows net operating loss carrybacks, and this is very interesting or important to the business owners that are watching. NOL carrybacks will be permitted again. They were eliminated as part of tax reform, a year and a half ago? It seems like a decade ago now. Which means that losses from 2020, and I bet some of you are going to show losses this year, can be used to offset profits or income for 19 and prior years, and you can go back and do an amended return, get some money back from that. So that's something you definitely want to write down and make sure your tax preparer, and your tax preparer really should be us, the tax master, Doug CPA, and Dr. Jeff Camarda, EA. But regardless, you want to write that down when it comes time to do your 2020 return, and you have the final numbers, and go back and get some from prior years if you can. You probably got a good shot at that. And that's pretty much it. Again, we're looking forward to what the company's reporting tomorrow and Wednesday and through the week. So as those data stream in, we will opine and tell you what we think about them. Until tomorrow, thanks so much for working. Adios. Camarda signing out once again.